There's a lot of misinformation going around the internet about cash value life insurance, IULs specifically. If you haven't seen the latest news, there was some controversy around a NASCAR driver. Him and his wife came out and said they were scammed and lost millions and millions of dollars inside of their IUL policy, which they may have, but they came out on Instagram. And I may try to show a clip on this video.
These are people who are, they've worked hard, they've made a small business, they are ready to retire, and they buy into these scams and they lose absolutely everything. And
They work with a lawyer and a company that specifically targets wrongly designed IULs, agents, and companies. And don't get me wrong, there's a lot of garbage out there. And I want to get across in this video some of the lies you may hear when researching or looking into cash value life insurance, sometimes otherwise known as cash flow insurance, or the notorious IUL. My name's Mark. I've been in the insurance industry for almost a decade now. I've served hundreds of families. I've designed these IULs specifically so that the fees are minimal and the accumulation is higher. But I want to give you some lies that you'll hear agents and advisors give you all across the internet. There's just a lot of misinformation, and people are maybe sometimes even unintentionally sharing this information just because of their lack of knowledge, understanding, or training. The industry is rampant with new agents, people coming into the industry every single day. They think it's a get rich quick scheme. They think they can make a lot of money, and most people end up fizzling out if you can't do it long term. So in this video, I'm going to share 3 lies that you'll often hear from advisors or life insurance agents in the industry. And some of these lies you probably have heard yourself. Some you will hear later on. But these are things that, again, could be just because of lack of training, education, and understanding of the product. They're just kind of throwing spaghetti at the wall and seeing who bites. Okay, first lie. I hear this all the time. Matter of fact, I'm going to be fully transparent. When I first started, I used to say this on a regular basis on my videos until a very experienced advisor came to me and broke it down to me and truly explained the nature of the statement that I said and how it's giving a bad name for the industry. And that was corrected very, very quickly early on in my career. Lie number 1, you get market upside with 0 downside risk. Now, why is that a lie? It distorts the IUL's nature. It distorts its features. Yes, you do have a floor. The floor means if the market were to crash, the cash value inside the policy will not crash with the market. There's something called a 0% floor. Some carriers even offer 0.25%, even 1% floors, which means the minimum you can ever get in your policy could be that 1%, 0.25%, or 0. Now, 0%, you're thinking to yourself, oh, 0% is horrible. Think about it this way. We often call 0 hero because a person would rather 0% interest than negative 14% interest. Does that make sense? So the reality is, yes, you can get some upside potential of the market, but when you say you get upside potential of the market, some agents have often said you get the highs of the market without any of the lows. Big misconception, because an insurance product is an insurance product. It's not an investment. So even though the IULs are linked to the market or indices inside the market, you don't get the true market return. You get an average, typically over a 1-year period. So you'll get the median, the middle of the ups and downs of the entire 12-month period. And that's called the average return. And most IUL companies have a cap. Sometimes cap could be 9%, 10, 11, 12. There's different companies, different caps. And then there's something called a participation rate. Some strategies come with a lower participation rate. A 70% participation rate means you only capture 70% of whatever the true return is that year. Now, some carriers also offer higher participation rates, 150%, 200%. Often these higher participation rates will be linked to indices that typically don't perform well. An IUL can be a great companion to your overall portfolio and investment plan. It is not an investment, and it should never be considered an investment. You should have an IUL for protection, preservation, and conservative growth, somewhat like a bond allocation, right? Probably in most cases a little bit better returns than a bond, but it should never be compared to an IRA, a 401k, or anything directly invested in the market. Lie number two, cash value growth is tax-free. The truth is, the growth inside of the cash value policy is actually tax deferred. Now, yes, you're putting in after tax dollars that will typically never be taxed again because you have access to the loan feature inside of the policy. When you take loans from your cash value years down the road, you're not going to get taxed. Matter of fact, you don't even have to tell the IRS about that. You can take hundreds of thousands of dollars out of your accumulation value of your policy, and you don't have to report it as income. You don't have to report it on your taxes at all because it's money that's there sitting in an asset that you're just borrowing against. Tax-free retirement income could be a little bit misleading. The money actually building in that cash value policy is considered by IRS standards tax deferred, and it will grow tax deferred until it's liquidated. Now, you don't have to liquidate it because when you die and it passes to your beneficiary, it's still under IRS code 7702 considered a tax-free asset or an inheritance that goes directly to your family. So even though in your lifetime, if you withdrew it, you can withdraw up to the cost basis of what you put in, but anything else that has grown inside the policy as far as interest, you're going to get taxed. Most people never deal with that because they just use it via the loan option. They borrow, they pay it back, they borrow, they pay it back. When it goes to your family doesn't have to worry about taxes either. Now, if we want to get really technical and you have tens of millions of dollars, then we can start talking about estate taxes, inheritance taxes, but that's way up past $14 million. For those types of conversations, we would defer to something that's called a irrevocable life insurance trust, but I'll save that for another video. Now, the other part of that is there's something called a MEC, Modified Endowment Contract. And if you overfund it too much and it goes past that threshold that the IRS sets in place, you could pay taxes on the whole thing and the entire growth of the account. Essentially, it turns into nothing but an investment account at that point. It's not protected underneath IRC 7702. And again, we can go in depth in another video, but you want to be careful when you are max funding. Always keep in contact with the carrier. Make sure you know all of your values so that you do not go over the limit, because once you do, you can't retract it. Lie number three. An IUL will always outperform a traditional retirement account. You don't know how many gurus I've seen online, on Instagram, on even Facebook ads comparing an IUL to a 401k. You cannot do that. They're two completely different products used for two completely different things. To say an IUL will give you the same performance as a 401k is completely misleading, and that person's license should be probably revoked. This is what gives the industry a bad rap. This is where people start making unrealistic claims and exaggerated claims, and it just gets very, very messy. A 401k is a good step in the right direction. You're putting in pre-tax dollars, you're growing it, you're compounding it. You can use it later on for retirement. Now, there's limitations and there's risk factors involved in a 401k, market ups and market downs, and lots of risk. You could potentially lose a lot of your money too. Not to mention there's fees inside of a 401k as well, but there's also limitations inside of an IUL. Now, I have an IUL. I have IUL set up for my whole family. I love IULs, but I don't want it to replace something that's meant to be an investment, because an IUL should not be considered an investment. 401k is good. You can partner it with an IUL and have both tax deferred growth and post-tax growth inside of an IUL, after tax growth. But to say that your IUL will outperform your 401k, that can get very dangerous. Now, I want to be careful about this, because considering market loss in the 401k and sequence of returns. Again, that's another complicated topic. And IUL has a stair step mechanism because of the 0% floor. So when your 401k is losing money, your IUL is continuing to compound. It hits that 0% floor, but the moment the market picks up, you start to compound again in your IUL. So in one example that I've seen that comes somewhat close to the truth is all of the losses in a 401k could cause your portfolio to underperform so much that an IUL's conservative gains with its 0% floor could potentially be at a place where it's a little better as far as performance over a long period of time. We're talking 20 years, 30 years. But that's because there's no risk inside of an IUL when there is risk inside of a 401k or a IRA. You also have to understand in an IUL, it's an insurance policy. Unlike a 401k, when you put in $100 and your company matches $100, the only thing that's taken out of that may be brokerage fees, maybe 1%, 2%. In an IUL, there's typically a cost of insurance, there's expense charges, there's policy fees built into the policy, a little bit more fee heavy in the beginning years of the policy, but those fees end up falling off as the policy matures, and the policy overall should get cheaper over time as long as it's designed properly. Average in an IUL should be around 1 to 2% in cost of insurance and fees over the lifetime of a policy, when in a 401k, you could see 2 to 3% fees. And mind you, they're all hidden all over the place. You'll never read it in black and white. You'll see little hidden anonymous fees all over the place, but it equals out to around 2 to 3%. A lot of people don't know that. So you put the same $100 in an IUL, you don't have the match, but you have the cost of insurance that gets taken out of it, the expense charges, policy fee. So that $100 really, what goes into the cash value is only about $80 to $90. Again, if designed properly with lower death benefits so that it decreases the amount of commission and internal fees, cost of insurance, more cash value will go into that growth section of your policy. That's why it's so important to sit with somebody that you can trust, sit with somebody that's in your best interest versus their best interest. Now, that being said, if you'd like to sit down and review a case personally designed for yourself, I'll show you exactly what I do for myself and for my family. If you'd like to do that, click the link in this video. There should be a link to my calendar. You can watch a short video and you can get on my schedule. My calendar gets booked very fast during the holiday season, so make sure you get on the calendar fast and you book a call with us. If I can't assist you, one of my team members can definitely reach out to you as well. And the last little bonus that I'll throw your way is when financial advisors, not even life insurance agents, will say IUL is a scam. Stay away from life insurance partnered with investments. Dave Ramsey, Susan Orr, all these people talk about never mix insurance with investments. Well, I agree. There's something called a variable universal policy, which is a life insurance policy with an investment portion built in, and the investment can go up and the investment can go down. There is no floor like there is in an IUL. So if you have a VUL, be very careful with that. Get it checked out, do a policy review. You can reach out to my office as well. There could be a better option for you out there, specifically IUL, which is index universal, and it's not directly invested in the market, but it's linked to potential conservative market returns. Most financial advisors will tell you, stay away from IUL, stay away from whole life, stay away from cash value, because here's number one, they don't have the license to sell it. So when they put you in that product or when they refer you to somebody else, they end up losing out on that money, which they could have managed in a portfolio and an investment account, and they could have been making money on that, right? So that's one of the main reasons people say, or advisors say, stay away from life insurance. If your life insurance advisor is truly fiduciary, he'll show you those options of what an IUL could look like and what a 401k and this investment and that investment. If he's well-rounded, typically they'll have an insurance license as well, and they'll at least make sure you have a properly designed life insurance policy over you and your family. Now, whether that's term or IUL or permanent, that's completely up to you. Term only lasts for so long, and perfect world scenario, you'd have enough money by the time that term runs out to be self-insured. Most people don't, unfortunately. That's Dave Ramsey's philosophy. Get a term for 30 years. Within that 30 years, get rid of debt, save as much as you can, be a millionaire, and self-insure yourself, right? You don't need life insurance at that point. 99.9% of people can't do that. Very small percentage of people actually do that. So, well, guys, I hope this video was informative. This is the first of 25 videos in the month of December. This is part of our Vlogsmith series. I'm going to answer one question every single day or give you a topic for you to think about. My name is Mark Casera. Been in the industry for almost a decade. Watch some of the other videos, maybe around the screen right here. Click the link in my bio. Get on my calendar if you'd like to book a call. And I look forward to seeing you in the next video. If you haven't done so yet, make sure you subscribe, click that thumbs up, share this video with a couple friends, and I'll see you in the next one.